Before we begin, a quick and important disclaimer. I am not a licensed financial advisor or insurance professional. The information provided in this video is for educational and entertainment purposes only. It should not be considered as financial or legal advice. You should always consult with a qualified professional before making any decisions regarding your insurance coverage. Your financial situation is unique, and the strategies discussed here may not be suitable for everyone. You open the envelope. It's your car insurance renewal. You take a deep breath, hoping, praying, it's not as bad as you fear. You unfold the paper, and your eyes scan down to the new premium. And there it is. Your jaw tightens. Your stomach drops. It's up. Not by a little. It's up 20%, 30%, maybe even 50%. And the first thing you think is, why? You haven't had a single accident. Not one ticket. You've been a loyal customer for years. You did everything right. So why does it feel like you're being punished? If this sounds familiar, you are not alone. You're not going crazy. And you're not just unlucky. Right now, millions of Americans are opening that same letter and feeling that same gut punch. In just the last year, the average cost of full coverage car insurance in the United States has exploded by a staggering 26%. It's now well over $2,000 a year for the average driver. And in states like Florida and New York, it's soaring past $3,000. This isn't just inflation. This is a crisis. It's the single biggest cost increase for many American households, and it's happening with almost no explanation. Feels unfair. Feels like a scam. But what if I told you it's not random? What if I told you there are specific, identifiable forces at work behind the scenes, creating a perfect storm that is intentionally designed to drain your bank account? In this investigation, we are going to pull back the curtain on the entire U.S. auto insurance industry. We're not just going to complain about the prices, we are going to arm you with knowledge. We will dissect the three colossal forces that are secretly driving your rates into the stratosphere. And most importantly, by the end of this, you will understand the game so you can stop being a victim and start fighting back. We're going to give you the playbook to potentially slash hundreds or even thousands of dollars from your bill. To understand this crisis, you have to understand that it's not just one thing. It's a combination of factors all hitting at the exact same time. Think of it like a hurricane. There's the wind, the rain, and the storm surge. Each one is a problem, but when they combine, they create a catastrophe. Your insurance bill is that catastrophe. The first front of this storm, the gale force wind hitting your wallet, is the car you are driving right now. It doesn't matter if it's a brand new pickup or a 5-year-old sedan. The vehicle sitting in your driveway is fundamentally different from any car that has ever existed before. And that difference is costing you a fortune. We used to think of cars as mechanical machines, an engine, four wheels, and a steel frame. Simple. But today's cars are not machines. They are supercomputers on wheels. Your modern vehicle has more lines of code than a Boeing 787 jet. It's packed with dozens of microchips, cameras, radar, and sophisticated sensors that control everything from your brakes to your radio. This technology has made cars safer and more convenient than ever before. But it has also turned even the most minor fender bender into an incredibly complex and eye-wateringly expensive ordeal. Let's talk about a simple bumper. 10 years ago, if you backed into a pole, you'd get a dented piece of plastic and metal. You'd take it to a body shop, they'd fix it or replace it for a few $100. Annoying but manageable. Today, that same bumper is a technological marvel. It's embedded with multiple ultrasonic parking sensors, blind spot monitoring radar, and sometimes even cameras. That slow speed bump in the parking lot doesn't just dent the plastic anymore. It can damage a whole network of sensitive electronics. Replacing that bumper isn't a simple swap. The part itself costs a fortune, and once it's installed, all of those sensors have to be meticulously recalibrated by a highly trained technician using specialized, expensive equipment. That minor bumper repair that used to be $500, it can now easily cost $2,000, $3,000, or even $4,000. And your insurance company is paying that bill. Or how about your windshield? A rock flies up and leaves a crack. It used to be a $200 fix. But now, mounted behind your rearview mirror is a camera and sensor suite for your car's advanced driver assistance systems, or ADAS. This is the technology that runs your lane keep assist, your automatic emergency braking, and your adaptive cruise control. When that windshield is replaced, the camera has to be taken out and reinstalled. And just like the bumper sensors, it must be recalibrated with near-surgical precision. If that camera is off by even a single millimeter, Your car's safety systems could fail when you need them most. That recalibration process alone can add $500 to $1,000 to the job. A simple cracked windshield can now be a $1,500 insurance claim. It's everywhere. A side mirror isn't just a piece of glass anymore. It has a blind spot indicator light, a heating element, a motor to fold it, and sometimes a camera. A simple side swipe can turn into a $1,000 repair. A headlight isn't a $50 bulb. It's a sealed LED unit with adaptive technology that swivels as you turn. Replacing one can cost over $2,000. On some luxury trucks and SUVs, a single headlight assembly can cost more than $4,000 for one headlight. So when an insurer looks at your car, they no longer see a simple mode of transportation. They see a mobile network of incredibly fragile and expensive technology. The risk of a massive payout for even a minor accident has skyrocketed, and they are passing that risk directly on to you in the form of higher premiums. But the expensive tech is only part of the problem. This leads to the second related issue: the people who fix the cars. The number of qualified auto body and repair technicians in the United States has been plummeting for years. It's a physically demanding job, and the training required to work on these new computer-driven cars is immense. Young people aren't entering the trade fast enough to replace the retiring veterans. This has created a massive labor shortage. Basic economics tells you what happens next. When demand is high and supply is low, prices go up. Body shops are now forced to pay their top technicians huge salaries to keep them from being poached by competitors. That increased labor cost, often over $100 an hour, gets baked directly into every repair bill. So not only are the parts more expensive, but the labor to install and calibrate those parts is also more expensive. And finally, there's the third punch in this combination: the lingering ghost of the global pandemic. We're still dealing with a tangled, unpredictable global supply chain. A specific sensor or a computer module needed for your car's repair might be stuck on a container ship or delayed for months due to a factory shutdown halfway around the world. This creates a cascade of costs. First, the part itself becomes more expensive due to scarcity. Second, your car is stuck at the body shop for weeks or even months waiting for that part. And while your car is sitting there, what are you driving? A rental car. And who pays for that rental car? Your insurance policy. Insurers are now shelling out thousands of dollars for rental car fees on claims that used to take only a few days to resolve. It's another massive, hidden cost that gets funneled directly into the price you pay. So you have it. A trifecta of terror for insurance companies. Insanely expensive and complex technology, a shortage of skilled labor driving up repair costs, and a broken supply chain causing massive delays in rental car fees. This is the first front of the perfect storm. The very nature of the car itself has changed, and the entire repair ecosystem is cracking under the financial strain. Every single time there is an accident anywhere in the country, the cost to resolve it is exponentially higher than it was just a few years ago. And insurance companies, being businesses, are not going to absorb that cost. They pass it on to you. This alone would be enough to cause a massive spike in your insurance bill. But as staggering as these repair costs are, they are only 1/3 of the story. They are merely the wind of our hurricane. The second, and perhaps more frightening, force driving your rates up has almost nothing to do with the technology in your car. It has to do with the world outside your windshield. The roads you drive on, the weather, and even the people in the car next to you have all become more dangerous and more expensive in ways you can't even imagine. And that is where this story takes an even darker turn. Let's start with the very asphalt your tires roll on. For decades, America's roads were the envy of the world, a sprawling testament to engineering and ambition. But that was then. Today, our infrastructure is in a state of quiet, managed decay. The American Society of Civil Engineers gives our roads a D grade. D. Think about that. You wouldn't accept a D on your kid's report card. Yet we accept it for the very foundation of our transportation network. And this isn't just about a bumpy ride. This is about a constant, low-grade assault on your vehicle. Potholes, once a seasonal annoyance, are now a year-round plague. Hitting one in a 1995 Honda Civic might have just rattled your teeth. Hitting that same pothole in a 2024 SUV can be a financial catastrophe. It can crack a $2,000 alloy wheel, misalign a complex multi-link suspension system, or worse, damage the dozens of sensors now embedded in your car's undercarriage and bumpers, sensors for lane keeping, adaptive cruise control, and automatic emergency braking. A simple jolt can trigger a cascade of electronic failures, leading to a repair bill that looks more like a down payment on a used car. Insurance companies see this. They aren't just tracking major collisions, they're tracking the relentless tide of single-vehicle claims for suspension damage, tire blowouts, and cracked windshields from debris on poorly maintained highways. Each claim is a data point, and all those data points form a trend line that goes up and to the right. The very ground beneath your tires has become an adversary, slowly but surely chipping away at your car, and by extension, your wallet. But crumbling roads are a slow-moving disaster. The next force at play is anything but slow. It's violent, unpredictable, and it's happening more and more often. We're talking about the weather, not just a bit of rain or snow. We are talking about biblical-level weather events that are rewriting the risk calculus for insurance companies. In the 1980s, the U.S. averaged about $3 billion weather disasters per year. In the last 3 years, we've averaged over 20. That is a nearly 700% increase in catastrophic events. And cars are always on the front lines. Picture this. A supercell thunderstorm forms over the plains of Colorado or Texas. Within minutes, it begins dropping hail the size of baseballs. It's not just a storm. It's like a machine gun firing golf balls from the sky for 20 solid minutes. When it passes, entire towns look like they've been carpet bombed, and every single car left outside. In a driveway on the street in a dealership lot is a total loss. Thousands of vehicles instantly rendered worthless. An insurance company that might have insured a few hundred of those cars suddenly has to write checks for $10 million in a single afternoon from a single storm. Now multiply that. Think of the hurricane storm surges that flood entire coastal cities in Florida and Louisiana, turning tens of thousands of cars into waterlogged, corroded husks. Insurers call these flood cars, and they are almost always a total loss because the water destroys the complex electronics we talked about earlier. Think of the wildfires in California and the Pacific Northwest that move so fast they incinerate entire neighborhoods, cars included. These aren't isolated incidents anymore. They are the new normal. And when an insurer has to pay out $1 billion for a hurricane in Florida, they don't just raise rates on people in Florida. They can't. They have to spread that massive, staggering loss across their entire customer base. So a hailstorm in Texas can make your premium go up in Ohio. A wildfire in California can make your policy more expensive in Maine. You are now paying for disasters happening 1,000 miles away. Because in the interconnected world of insurance, we're all in the same risk pool. The environment itself has become more hostile to your car, and your policy is the price of that hostility. And yet, as terrifying as crumbling roads and apocalyptic weather are, they are not the darkest part of this story. Because the single most dangerous, unpredictable, and costly variable in this entire equation is us, the people behind the wheel. Something broke in the American driver during the pandemic, and it hasn't been fixed. When the lockdowns hit in 2020, the roads emptied out, and a certain segment of the population saw those empty highways not as a sign of a global crisis, but as their own personal racetrack. Speed skyrocketed. The number of drivers ticketed for going over 100 miles per hour exploded. People forgot how to share the road, or maybe they just stopped caring. Then, when the world reopened, that reckless, selfish driving mentality didn't go away. It stayed. It festered. And it merged with all the stress, anxiety, and political polarization of the last few years to create the most aggressive, distracted, and dangerous driving environment we have ever seen. Traffic fatalities, which had been trending downward for years, suddenly shot up. In 2021, nearly 43,000 people died on American roads. That's the highest number in 16 years. It's the equivalent of a 737 crashing with no survivors every single day for a year. The carnage is breathtaking, and insurance companies have a front row seat. They see the data in its rawest form. They see that the frequency of accidents is up. More people are crashing. But more importantly, the severity of those accidents is through the roof. These aren't just fender benders anymore. Thanks to higher speeds and more aggressive maneuvers, we're seeing more high-impact, multi-car pileups. We're seeing more cars totaled, not just damaged. And we're seeing more people getting seriously life-altering injured. Or worse, this is the human cost. But it has a direct financial translation. A minor rear-end collision might result in a $5,000 claim for a new bumper. A high-speed T-bone collision can result in a $500,000 claim after you factor in the totaled vehicles, the multiple ambulance rides, the emergency room visits, the surgeries, the months of physical therapy, and the lost wages. The biggest driver of this chaos? Distraction. The smartphone. We all see it. The driver next to you on the freeway, head down, bathed in the blue glow of their screen, swerving in and out of their lane. A study by Cambridge Mobile Telematics found that driver distraction is happening in a staggering 36% of all trips. More than 1 out of every 3 times you get in your car, you're sharing the road with someone who is texting, scrolling, or watching a video. This epidemic of distraction, combined with the post-pandemic aggression, has turned the daily commute into a game of Russian roulette. And every single crash, every single injury, every single death is a claim. And every claim is a data point that tells your insurer that the risk of you, a perfectly safe driver, getting hit by one of these reckless individuals has gone up dramatically. So they raise your rates. They have to. They are pricing in the risk of you encountering the driver who thinks a red light is a suggestion. The driver who merges without looking because they're arguing on social media. The driver who is doing 95 and a 65 because they're late and they feel entitled. The world outside your car has become a minefield. The roads are crumbling, the weather is more violent, and the other drivers are more dangerous than ever before. It's a perfect storm of external threats, each one adding another layer of cost, another percentage point increase on your insurance bill. But the story doesn't end there, because what we've covered so far is only what happens before and during the crash. The truly astronomical costs, the ones that are truly breaking the system, happen after the glass is swept away and the tow trucks have gone home. It's what happens in the hospital rooms, the physical therapy centers, the auto body shops, and most importantly, the courtrooms. And that is where this system has become so unbelievably, punishingly expensive that it's changing the very nature of driving in America. To understand this, we have to talk about a single tragic car crash that happened on a Florida highway in 2018. A college student was driving on I-95 when a truck illegally changed lanes in front of him, causing a chain reaction. The student's car was forced under another truck that had stopped for the traffic. The resulting crash was horrific. The young man was left a quadriplegic, needing round-the-clock medical care for the rest of his life. It was a clear case of negligence by the truck driver. The question wasn't if the trucking companies were at fault. The question was, what is the appropriate compensation for a life so completely and permanently shattered? The family's lawyers initially asked for a settlement. The trucking companies offered what seemed like a lot of money, but it wasn't enough to cover the lifetime of medical care the victim would need. So the case went to trial. And in that Florida courtroom, the jury came back with a verdict. They awarded the family $1 billion. $1 billion. With a B. $400 million for past and future medical expenses, and $600 million for pain and suffering. Now, that number was later reduced by the judge, and the final settlement was kept confidential. But the message had been sent. That $1 billion number echoed through the entire transportation and insurance industry like a sonic boom. This wasn't just a verdict. It was what the legal world now calls a nuclear verdict. A jury award so massive, so far beyond any rational calculation of damages, that it threatens to financially annihilate the defendant. And these nuclear verdicts are exploding across the country, turning courtrooms into the epicenter of our insurance crisis. So why is this happening? Are juries just getting more emotional? That's part of it, but there's something much more systematic, more calculated going on. It's a legal strategy that has a nickname straight out of a psychology textbook, the reptile theory. The idea is simple but devastatingly effective. A plaintiff's attorney isn't just arguing the specifics of a single accident anymore. They're not just saying, this company's driver made a mistake, and my client got hurt. Instead, they reframe the entire trial. They argue that the company didn't just make a mistake. They willfully violated a safety rule that puts the entire community in danger. The lawyer's goal is to trigger the most primitive part of the juror's brains, the reptilian brain, which is concerned with only one thing: survival. They'll say things like, this isn't just about my client. This is about public safety. This company chose profits over people. They cut corners on training, on maintenance, on safety protocols. And if you don't punish them with a verdict so large it sends a message to the entire industry, then what's to stop them from doing it again? What's to stop the next truck from running a red light and hitting your child or your spouse? Suddenly, the jurors aren't just deciding compensation for one person. They see themselves as the guardians of the community, the last line of defense against a dangerous, greedy corporation. And when you feel like you're protecting your own family from a predator, awarding $100 million or even $1 billion doesn't seem unreasonable. Feels like a civic duty. Feels like survival. This strategy is taught in seminars, written about in books, and has become the go-to playbook for trial lawyers across the country. And it works. The U.S. Chamber of Commerce found that from 2010 to 2019, the median nuclear verdict in trucking cases skyrocketed by over 1,000%. The average verdict against a trucking company now exceeds $26 million. But there's another, even more secretive force pouring gasoline on this fire. It's called third-party litigation funding. Imagine you're a lawyer with a promising personal injury case. Your client is badly hurt, the defendant is clearly at fault, but the defendant is a massive corporation with an army of lawyers. They're going to drag this out for years, bury you in paperwork, and try to make you run out of money before you ever see a courtroom. This is where the funders come in. These are hedge funds, private equity firms, and specialized investment groups who will pay for the lawsuit. They'll front all the money, for expert witnesses for depositions, for your legal team's salaries, in exchange for a cut of the final settlement or verdict. Sometimes a very big cut like 30 or 40%. This changes everything. It's no longer a regular person versus a giant company. It's a giant company versus a regular person who is now bankrolled by another giant, invisible financial firm. A lawsuit is no longer just a legal dispute. It's become a financial asset class, an investment vehicle for Wall Street. And think about the incentives this creates. If an investment firm has poured $5 million into your case, they're not interested in a quick, reasonable $10 million settlement. They're hunting for whales. They are pushing for that nuclear verdict. They have the money and the patience to refuse all settlements and roll the dice in front of a jury, coached by reptile theory tactics, hoping to hit that billion-dollar jackpot. This industry is almost entirely unregulated, operating in the shadows. We often don't know who is funding a lawsuit, how much they've invested, or what their cut will be. It's a hidden multi-billion-dollar industry that is directly incentivizing bigger and bigger lawsuits. So, how does a billion-dollar verdict against a trucking company in Florida make your car insurance in Ohio or California go up? It's because the entire insurance system is interconnected. When an insurance company has to pay out a $100 million claim, they don't just pull that money out of a checking account. They themselves have insurance. It's called reinsurance. It's the insurance that insurance companies buy to protect themselves from catastrophic losses. And right now, the reinsurers are looking at these nuclear verdicts and they are panicking. They see the reptile theory and third-party litigation funding as a fundamental shift in risk. The potential for a massive, unpredictable loss on any given policy has gone through the roof. So, they dramatically increase the price of reinsurance for everyone. That cost gets passed down the chain. The primary insurance company, your Geico, your Progressive, your State Farm, now has to pay way more for its own safety net. On top of that, they have to set aside billions more in their own cash reserves, just in case they get hit with one of these verdicts themselves. Where do they get that money? They get it from you, and me, and every other person with a car insurance policy. Every premium we pay is now silently loaded with a nuclear verdict tax. A portion of your monthly payment is going to fund this new reality, this high-stakes legal arms race. We are all paying to cover the potential cost of the next billion-dollar judgment. The system that was designed to make victims whole has been supercharged by new legal tactics and Wall Street money, creating a feedback loop of ever-increasing costs that are being spread across every single driver in America. But this legal explosion is only one half of the equation, because while the lawyers were getting smarter and the lawsuits were getting bigger, the cars themselves were undergoing a quiet revolution. They were becoming computers on wheels. And that intelligence, that incredible technology designed to save our lives, has come with a price tag so shocking, it's making even a simple fender bender a financially catastrophic event. The very thing meant to protect us is now helping to break the bank. Let's start with something that seems incredibly simple. Your windshield. For decades, a rock chip or a crack was an annoyance, sure, but it was a predictable, manageable expense. A couple $100, a mobile glass guy comes to your office, and you're done in an hour. Today, that same rock chip can trigger a repair bill that looks like a typo. We're talking $1,000, $1,500, even $2,000 or more. Why? Because that piece of glass is no longer just a piece of glass. It's the car's electronic eye. Embedded within it, or mounted directly behind it, is a suite of sophisticated cameras and sensors. This is the hardware that powers your lane-keeping assist, your automatic emergency braking, your adaptive cruise control. When you replace that windshield, you're not just swapping glass. You're performing a delicate transplant on the car's central nervous system. And after the transplant, the system needs to be taught how to see again. This is where we hit the first massive, hidden cost driver: calibration. That camera needs to be aimed with microscopic precision. If it's off by a single degree, the width of a human hair, it could misjudge the distance to the car in front of you. It might not see a pedestrian stepping into the road until it's too late. Or it might slam on the brakes on the highway for no reason, thinking a shadow is a solid object. The stakes are quite literally life and death. So, this calibration process isn't done with a wrench and a good eye. It requires a perfectly level shop floor, specialized targeting boards that look like something out of an optometrist's office from the future, and diagnostic computers that cost tens of thousands of dollars. And it requires a technician who has been extensively trained to use it all. That specialized labor and that expensive equipment, that cost gets baked directly into what used to be a simple windshield replacement. And your insurance company is the one footing the bill. Now, multiply that single example across the entire vehicle. Take the humble bumper. It used to be a piece of chrome or plastic designed to absorb minor impacts. Now your car's bumpers are nerve centers. They're packed with ultrasonic parking sensors, radar units for blind spot monitoring, and sensors for cross-traffic alerts. A gentle tap in a parking lot that might have once just scuffed the paint can now crack a $500 sensor. And just like the windshield, it's not a simple plug-and-play. That new sensor has to be integrated and calibrated with the rest of the car's network. A rear-end collision that would have cost $2,000 to fix 10 years ago can now easily eclipse $10,000 or $12,000. The cost of the parts themselves has skyrocketed. A single LED headlight assembly on a modern truck or luxury SUV can cost more than $3,000. 1. Headlight. A side mirror which now contains a camera, a heater, a blind spot indicator light, and a motor can be over $1,000 to replace. This creates a brutal financial equation. The technology is absolutely making cars safer. The Insurance Institute for Highway Safety, the IIHS, has found that forward collision warning systems cut front-to-rear crashes by 27%. Add in automatic emergency braking, and that number jumps to 50%. That's incredible. It's saving lives and preventing injuries. But the paradox is that for the 50% of crashes that still happen, the cost to repair the damage is exponentially higher. We've engineered away the cheap accidents. The minor fender benders that used to be a $1,000 nuisance are now a $10,000 nightmare. And this leads us to the second major problem, the stranglehold of the manufacturers. We're talking about original equipment manufacturer parts, or OEM. When you're dealing with these complex safety systems, body shops and insurance companies are often forced to use the official parts from the car maker. You can't just grab a cheaper, aftermarket sensor for the automatic braking system. The risk of it failing is too great, the liability is too high. The car's own software might reject the part entirely, lighting up the dashboard like a Christmas tree. This gives car manufacturers a near monopoly on these critical high-tech replacement parts. And when you have a monopoly, you can set the price. There's no competition to drive the cost down. So when a dealership charges $2,000 for a plastic bumper cover embedded with sensors, the insurance company has little choice but to pay it. They can't source it from a cheaper supplier because one doesn't exist. This isn't a free market. It's a captive market. And you, through your insurance premiums, are the one funding it. Then there's the human element, the technician, the person who actually has to fix this rolling supercomputer. The days of the shade tree mechanic being able to fix a modern car are over. Today's auto repair technicians need to be part mechanic, part electrician, and part IT specialist. They need to understand complex wiring diagrams, be able to diagnose software glitches, and operate that six-figure calibration equipment we talked about. There is a massive nationwide shortage of technicians with this level of skill. The Bureau of Labor Statistics estimates the industry needs tens of thousands of new technicians every year just to keep up with demand and retirements, and we are not even coming close. It's a demanding, highly skilled job, and there just aren't enough people going into the field. So what happens when demand for a specialized skill vastly outstrips supply? The price of that skill goes through the roof. Shop labor rates have been climbing aggressively, not just because of general inflation, but because the cost of attracting and retaining a technician who can correctly recalibrate your lane-keeping assist camera is incredibly high. That $75 an hour shop rate is quickly becoming a $150 or even $200 an hour rate for specialized electronic work. And a complex repair on a modern vehicle can involve 10, 20, even 30 hours of labor. You can do the math. So let's piece this all together. A minor collision occurs. First, the cost of the physical parts, the bumper, the headlight, the grille, is 3 to 4 times higher than it was a decade ago because they are no longer simple pieces of plastic and metal. They are complex electronic components controlled by a manufacturer monopoly. Second, the labor required to replace these parts is far more complex, involving the careful disconnection and reconnection of a dozen sensors and cameras. Third, after the physical repair is done, the car must undergo hours of painstaking electronic calibration, using expensive equipment to ensure the safety systems that were disturbed work perfectly. And fourth, all of this work must be done by a highly sought-after, highly paid specialist, because the supply of qualified technicians is critically low. This is the perfect storm. It's a cascading failure of cost controls. A 5-mile-per-hour tap in a grocery store parking lot can now generate a repair bill that costs more than a reliable used car from a decade ago. We have brilliantly engineered cars that are better than ever at avoiding an accident, but are financially ruinous to fix when one inevitably happens. The systems designed to mitigate risk have, ironically, introduced a whole new kind of extreme financial risk into the system. The insurance companies are sitting in the middle of this, watching these repair invoices come in. They're seeing a simple rear-end collision on a brand-new pickup truck that resulted in no injuries, no airbag deployment, and a perfectly drivable vehicle, still come with a final repair bill of $17,000. And they're seeing thousands of these every single day. They aren't just paying for a dented bumper anymore. They're paying for sensors, cameras, radar units, software licenses, and hours of IT support. This raises a terrifyingly expensive new question. If a relatively minor repair now costs $15,000 or $20,000, what happens when the damage is more severe? At what point does the insurance company, looking at a vehicle with a bent frame and a deployed airbag, simply throw up its hands and say, "It's over"? The line between a fixable car and a totaled car has moved, and the consequences of crossing that line are now more expensive than ever before, creating yet another massive engine of rising costs that is punishing us all. And at the heart of that punishment is a simple, terrifying calculation. When your insurance company declares your car a total loss, they owe you its actual cash value. PSV. That's the amount of money you would need, in that moment, to go out and buy a comparable replacement vehicle. For decades, this was a predictable, depreciating number. A 3-year-old car was always worth less than a 2-year-old car. It was a law of financial physics. But in 2020, physics broke. When the pandemic hit, the world's supply chain snapped. Automakers, expecting a massive recession, canceled their orders for semiconductor chips. But the recession they planned for never really came. People, flush with stimulus money and unable to spend it on travel or restaurants, decided to buy things. Laptops, TVs, and cars. Suddenly, automakers wanted to restart their factories, but the chip manufacturers had already promised their supply to other industries. The result was a catastrophic shortage of new cars. Dealership lots, once overflowing, became barren ghost towns. The few new cars that did arrive were sold with massive markups before they were even unloaded from the truck. And so the entire country all at once turned to the used car market. What happened next was a feeding frenzy. A desperate, nationwide scramble for a finite number of vehicles. It was basic economics weaponized. Demand went vertical while supply flatlined. And prices went to the moon. We entered a bizarro world where used cars were appreciating assets. A 2-year-old Toyota Tacoma with 20,000 miles on it was selling for $5,000 more than a brand new one. People were trading in their cars for more than they originally paid for them. The Manheim Used Vehicle Value Index, the gold standard for tracking wholesale used car prices, shot up by an almost unbelievable 45% in 2021 alone. It was the single largest, fastest increase in the history of the automobile. Now, imagine you're the insurance company. Your entire business model is built on decades of data that says a 2018 Honda Accord is worth, say, $16,000. You've priced all your premiums based on that assumption. But then, in 2022, one of your customers gets into a wreck and that same 2018 Accord is totaled. You look up its actual cash value, and the number that comes back isn't $16,000. It's $24,000. Your liability on that single vehicle didn't just creep up. It exploded by 50%. And this wasn't happening for one car. It was happening for every single totaled car in the country, millions of them, all at the same time. The predictable, manageable cost of totaling a car had become a gusher of red ink. Payouts that were once routine became catastrophic losses. The money they collected in premiums, based on the old world's math, was suddenly nowhere near enough to cover the checks they were now forced to write in the new world. Every totaled car became a financial grenade, blowing a hole in their balance sheets. And who do you think pays to patch those holes? We do. Our premiums had to be massively adjusted upwards just to account for this new, inflated reality where every car on the road represented a much bigger potential loss. But the nightmare didn't end there, because for every car that's totaled, there are dozens more that are just damaged. Damaged cars that now take weeks or even months to repair thanks to those same supply chain issues and labor shortages we talked about. And while your car is sitting in the shop, what do you need? A rental car. This brings us to the second hidden crisis, the rental car apocalypse. When the pandemic started, rental car companies like Hertz and Avis were facing bankruptcy. Nobody was traveling. So, to generate cash and survive, they did the only thing they could. They sold off huge portions of their fleets. Hundreds of thousands of cars were dumped into that already hot used car market. But when travel demand came roaring back, they had a massive problem. They tried to buy new cars to rebuild their fleets, but they couldn't get them. The automakers had no cars to sell. Suddenly, the country was facing a severe rental car shortage. And just like with the used car market, prices went insane. A standard sedan that used to cost $35 a day was now $120. In popular tourist spots, it was $200, $300 a day, if you could even find one. Now, think about your insurance policy. Most of us have rental reimbursement coverage. It's usually a fixed amount, something like $30 or $40 per day, with a total cap of maybe $900 or $1,200. For years, that was perfectly adequate. A simple fender bender might take a week to fix. 7 days at $30 a day is $210, well within your limits. But now, that same repair takes a month. And the rental costs $100 a day. Your $40 a day coverage is a drop in the bucket. You're paying $60 a day out of your own pocket. And after just 15 days, you've hit your $1,200 total limit. Your car is still in pieces at the body shop, but your insurance coverage is maxed out. You're now paying the full $100 a day yourself for weeks on end. The stories from this period are legendary. People taking $1,000 Ubers, renting U-Haul pickup trucks just to get around. The insurance companies were caught in a vice. On one side, they had customers furious that their rental coverage, which they'd paid for, was now practically useless. On the other, they faced the choice of either sticking to the policy limits and creating an army of angry clients, or paying out thousands of dollars above the policy limits just to keep people on the road while their cars were being fixed. Either way, their costs skyrocketed. It was another unforeseen, unpriced catastrophe that landed squarely on their books. So we have cars that are more expensive to fix, cars that are more likely to be totaled. And when they are totaled, the payouts are astronomically higher than ever before. And when they're just being repaired, the cost to provide a temporary replacement vehicle has also exploded. It's a perfect storm of compounding costs. Every single stage of the post-accident process has become dramatically more expensive. But all of this, the parts, the labor, the used car values, the rentals, it all assumes one thing: that the number and severity of accidents is holding steady. But it's not. Not even close. Because while the cars were changing and the supply chains were breaking, something else was changing too. The drivers. And the way we behave behind the wheel has unleashed a wave of destruction on American roads, creating a public health crisis that insurance companies are calling a severity tsunami. And its wake is swamping us all. This term, severity tsunami, it sounds like corporate jargon, like something cooked up in a boardroom to justify raising your rates. But it's not. It's a reflection of a grim reality playing out on our highways every single day. To understand it, we have to go back to a moment in time we all remember. The spring of 2020. The world shut down. The roads for the first time in our lives went quiet, eerily empty. And in that emptiness, a new type of American driver was born. With no traffic, no rush hour, no one to get in the way, speed limits became suggestions. Open stretches of interstate became personal raceways. People started driving with a sense of freedom, of abandon, that they'd never felt before. And it was for a moment exhilarating, but it was also a training ground. We were, as a nation, collectively teaching ourselves a new, more aggressive, more reckless way to drive. And habits once learned are incredibly hard to break. When the world opened back up and the cars returned, the traffic returned, the congestion returned, but the habits remained. The muscle memory for that aggressive driving was now baked in. People who got used to flying down the freeway at 90 miles an hour were now trying to do it in bumper-to-bumper traffic. The result was predictable, and it was catastrophic. In 2021, traffic fatalities in the United States surged to a 16-year high. Nearly 43,000 people died. That's like a fully loaded Boeing 737 crashing. with no survivors every single day for an entire year. Let that sink in. The National Highway Traffic Safety Administration, or NHTSA, called it a crisis. They pointed to the data. Deaths from multi-vehicle crashes were up 16%. Deaths on urban roads, up 16%. Deaths in speeding-related crashes, up 5%. We were crashing more and we were crashing harder. This wasn't a blip. The numbers stayed terrifyingly high in 2022 and 2023. We had fundamentally changed how we drive. We became more impatient, more prone to road rage, more willing to take risks. But this new aggression was mixing with another, even more insidious epidemic that had been simmering for years. The epidemic of distraction. And I'm not just talking about texting. That's almost quaint now. The modern car is a rolling command center of distraction. The dashboard is no longer a simple set of gauges. It's a glowing interactive tablet demanding your attention. You're navigating a complex infotainment system to change the music, adjusting intricate climate controls through submenus, all while your phone, mounted on the dash, buzzes with a constant stream of notifications from a dozen different apps. It's a relentless multi-front war for your attention, and you are losing. Neuroscientists have a term for this: inattentional blindness. It's a phenomenon where you can be looking directly at something, but you don't actually see it because your brain is focused on something else. You're looking at the road, but you're thinking about the email you're about to send. Your eyes see the brake lights of the car in front of you, but your brain is processing the podcast you're listening to. In that split second of cognitive disconnect, you fail to react. Think about it. How long does it take to read a text message? 5 seconds. The NHTSA says that at 55 miles per hour, taking your eyes off the road for 5 seconds is the equivalent of driving the entire length of a football field, completely blind. Would you ever agree to close your eyes and floor it for 100 yards down the highway? Of course not. But we do it, functionally, dozens of times a day. We check the GPS. We glance at a notification. We answer a call on speakerphone, which still hijacks our cognitive focus. In 2022, the NHTSA estimated that distracted driving was a key factor in over 3,300 deaths and nearly 300,000 injuries. And everyone knows that's a massive undercount because very few drivers involved in a crash will admit, "Yeah, I was watching a TikTok video." We are addicted to our devices, and we're taking that addiction with us into 2-ton metal boxes that we hurl at each other at deadly speeds. So now let's connect this back to your insurance bill. The insurance industry is, at its core, a giant pool of money. We all pay our premiums into the pool. When someone has a crash, they make a claim, and the money to pay for it comes out of that pool. For decades, the system worked because the amount of money going in was more or less balanced with the amount of money going out. But what happens when the withdrawals suddenly get bigger and more frequent? The severity tsunami is the perfect storm of these two behavioral crises. You have the post-pandemic aggression, the speeding, the reckless lane changes, which means that when crashes happen, the impact is much more forceful. This isn't a fender bender anymore. It's a high-speed collision. Cars aren't just damaged, they're totaled. Remember from our last part how expensive cars are to repair and replace now? This new driving style sends more of them to the scrapyard, triggering a full replacement payout from the insurance company. That's a massive withdrawal from the pool. Then you add in the distraction, the inattentional blindness. This leads to more crashes overall, more withdrawals from the pool. But it's the combination that's truly lethal for the system. A distracted driver who is also speeding doesn't just cause a crash, they cause a catastrophic multi-car pileup. And we haven't even talked about the most expensive part of any crash, the human body. The same forces that are totaling these advanced, expensive cars are also causing more severe, life-altering injuries to the people inside them. A minor whiplash claim from a 20-mile-per-hour bump is one thing. A claim for spinal cord injuries, traumatic brain damage, and lifelong medical care from a 65-mile-per-hour highway wreck is something else entirely. We're talking about medical bills that can easily run into the hundreds of thousands or even millions of dollars for a single person. Each one of those tragic accidents, each one of those totaled cars, each one of those devastating injuries represents a claim, a withdrawal from that collective pool of money. And for the past 3 years, the withdrawals have been relentless. They've been bigger, more frequent, and more severe than at any point in modern history. The pool is being drained faster than it can be refilled. So when an insurance company sees this happening, they have only one lever to pull to keep the pool from running dry. They have to increase the price of admission. They have to raise everyone's premiums. Your rate hike isn't just about your driving record anymore. It's about the collective driving record of an entire country that has, in many ways, forgotten how to drive safely. It's the price we all pay for the carnage on our roads. This wave of human behavior is a powerful force, but it's crashing into another, equally powerful force that's making everything exponentially worse. Because while we've been driving more recklessly, the cost of holding someone accountable for that recklessness has been exploding in America's courtrooms. A phenomenon known as social inflation is turning routine accident lawsuits into lottery-sized payouts, pushing the entire system to its breaking point. And this explosion isn't random. It's a calculated systemic shift in how we value an injury, and more importantly, who we believe should pay for it. Welcome to the world of social inflation, the invisible force adding hundreds, if not thousands, of dollars to your annual insurance premium. The term sounds academic, like something out of an economics textbook, but its reality is raw, emotional, and playing out in courtrooms in every state. At its core, social inflation is a perfect storm of changing public attitudes, aggressive legal strategies, and a whole lot of new money pouring into the system. Let's start with the attitudes. There's a growing sentiment in America, a deep-seated distrust of large corporations. People are more inclined than ever to see a big company, like a commercial trucking firm or an insurance carrier, not as a business, but as a faceless entity with infinitely deep pockets. So when an accident happens, the thinking shifts from, what is fair compensation for this injury, to how much can we get from this company to punish them and send a message? This sentiment is the fertile ground where a revolutionary and controversial legal strategy has taken root. It's called the reptile theory, and it's one of the single biggest reasons a simple fender bender can now result in a verdict that looks like a Powerball jackpot. The theory is brilliantly simple and psychologically terrifying. It argues that you can win over a jury by bypassing their rational, logic-driven brains and appealing directly to their most primitive, survival-oriented instincts, their reptile brain. The reptile brain doesn't care about evidence, statutes, or the fine print of an insurance policy. It cares about one thing: survival. It's constantly scanning the environment for danger and seeking safety for itself and its community. Lawyers using this strategy reframe a lawsuit away from the specific details of one accident. They stop arguing about who ran the red light. Instead, they create a much bigger, scarier narrative. They'll say something like, "This isn't about my client's broken leg. This is about a reckless trucking company that puts profits over people, that endangers our children, our families, every single day they put a truck on our roads. You, the jury, are the only thing standing between this dangerous predator and our community's safety." See what they did there? The case is no longer about compensating an individual. It's about eliminating a threat. The juror is no longer an impartial observer. They're a guardian at the gates. The defendant is no longer a company that made a mistake. They're a dangerous reptile that needs to be caged. And the only way to do that, the only way to make the community safe, is to hit them with a verdict so massive, so financially crippling, that they can never ever pose a threat again. This strategy transforms juror anger into astronomical damage awards, turning pain and suffering from a compensatory figure into a punitive weapon. These are called nuclear verdicts, judgments over $10 million, and their frequency has been skyrocketing. But anger and psychology alone aren't enough to fuel a multi-billion-dollar shift in an entire industry. You need cash, lots of it. And that brings us to the second, and perhaps most secretive driver of social inflation: third-party litigation funding. Imagine you're in a car accident. You have a legitimate case, but you're up against a massive insurance company with an army of lawyers. You can't afford a long, drawn-out legal battle. Historically, this power imbalance would lead you to accept a smaller, faster settlement. Not anymore. Today, a new player has entered the game: Wall Street. Hedge funds, private equity firms, and specialized investment groups are now pouring billions of dollars into the business of lawsuits. It works like this. A litigation funding company will approach a plaintiff or their lawyer and offer to bankroll the entire case. They'll pay for the legal fees, the expert witnesses, the court costs, and even provide the plaintiff with cash advances to live on while the case proceeds. In exchange, if the plaintiff wins, the funder gets a huge chunk of the settlement, sometimes 30, 40, or even 50%. If the plaintiff loses, the funder gets nothing. For the person who was injured, it's a risk-free deal. For the funders, it's the ultimate high-risk, high-reward investment. They're not betting on stocks or bonds. They're betting on jury verdicts. And this has fundamentally broken the old model of settlements. An insurance company might offer a perfectly reasonable settlement of, say, $1 million. But if a litigation funder has already invested $500,000 into the case and is promised 40% of the final award, they'll push the lawyer to reject the settlement and go to trial. Why? Because they're not looking for a reasonable return. They're hunting for a $10 million grand slam. They have no emotional connection to the case. It's just an asset on a spreadsheet, and their goal is to maximize its value, no matter how long it takes or how much it costs. This turns every major lawsuit into a high-stakes poker game where one side is playing with house money. It removes the financial pressure on plaintiffs to settle, encouraging them to roll the dice on a massive jury award, clogging up the courts and forcing insurers to fight longer, more expensive battles. And who pays for those battles? You do. Every nuclear verdict, every prolonged funder-backed lawsuit is a data point that gets fed back into the system. Insurance companies aren't charities, they are risk assessors. When they see a trend of $10 million verdicts for accidents that used to settle for $100,000, they have to adjust their models. They have to collect more in premiums from everyone to build a big enough pool of money to cover these potential mega losses. So that verdict against a trucking company in Texas absolutely affects your insurance rate in Maine. It's a signal to the entire industry that the cost of a single mistake has gone up by a factor of 10, or even 100. The pool of money has to get deeper to absorb the impact. Your premium is your contribution to that pool. It's the ultimate group project, and a few people are running up the bill for everyone. We have a legal system that's being psychologically manipulated by reptile brain tactics and financially supercharged by Wall Street investors who have turned human tragedy into a speculative asset class. This isn't just a few outlier cases anymore. It's a well-oiled multi-billion-dollar industry, meticulously designed to extract as much money as possible from the system. And the tactics they're using go far beyond the courtroom, targeting you with ads on your television, your social media feed, and your local billboards every single day. The question is, how did we let it get this powerful? To understand how, you have to look at the system not as a single entity, but as a business ecosystem that evolved over decades. It started with a noble purpose. The idea of tort law, the basis for personal injury claims, is simple and just. If someone harms you through their negligence, they should be responsible for making you whole again. They should cover your medical bills, your lost wages, and compensate you for your pain and suffering. For a long time, this system functioned more or less as intended. It was a legal tool for genuine victims. But then, a few key changes happened that turned this tool into a multi-billion-dollar industry. The first, and arguably most important, was the popularization of the contingency fee. You've heard the slogan 1,000 times. We don't get paid unless you get paid. On the surface, it's a powerful force for justice. It gives the little guy, someone with no money for expensive legal fees, a way to take on a massive corporation. It levels the playing field. But it also fundamentally changed the incentive structure. A lawyer working on contingency isn't just an advocate for their client. They're an investor in their client's injury. Their return on investment is directly tied to the size of the settlement or verdict. This simple shift transformed personal injury law from a service into a product, and the goal became maximizing the return on that product. But even with this new incentive, the industry was still relatively constrained. For most of American history, it was considered deeply unethical, and in most places illegal, for lawyers to advertise their services. The profession was seen as a dignified calling, not a commercial enterprise. You found a lawyer through word of mouth or a referral, not from a flashy ad during a daytime talk show. All of that changed in 1977. In a landmark Supreme Court case, Bates versus the State Bar of Arizona, the court ruled that state bar associations could not prohibit lawyers from advertising. The justices argued that a ban on advertising violated the First Amendment's free speech protections, and that it kept consumers in the dark about the availability and cost of legal services. The floodgates opened. What started as small text-only ads in newspapers quickly morphed into the aggressive, high-production value marketing campaigns we see today. Suddenly, law firms weren't just law firms, they were brands. They needed slogans, jingles, and memorable phone numbers. They needed to be on billboards, on the sides of buses, and on television 24 hours a day. The legal industry discovered the power of mass marketing, and they started spending billions to get their message out. That message was simple and powerful. Have you been in an accident? You could be entitled to a large cash settlement. Don't talk to the insurance company. Call us first. They weren't just serving existing clients anymore. They were actively creating a market, convincing people who might have just exchanged insurance information and moved on that their minor fender bender was actually a winning lottery ticket. This new aggressive marketing coincided with another major shift in the insurance world: the rise and partial failure of the no-fault system. In the 1970s, many states grew tired of small accident claims clogging up the courts. They introduced no-fault laws, which were supposed to be a simple solution. The idea was that if you were in an accident, your own insurance company would pay for your initial medical bills and lost wages up to a certain limit, regardless of who was at fault. This was called personal injury protection, or PIP. In theory, this would handle the vast majority of minor claims quickly and efficiently, without lawyers and lawsuits. But that's not what happened. Instead, the system created a whole new set of loopholes for the legal industry to exploit. The thresholds for what allowed you to step outside the no-fault system and file a traditional lawsuit were often vague. Was your injury serious or permanent? Lawyers became experts at arguing that even minor soft tissue injuries met these thresholds. More importantly, the guaranteed payout from PIP coverage created a new, risk-free revenue stream. This gave birth to what many in the industry call the medical legal industrial complex. Here's how it works. You're in a minor accident. You see a lawyer's ad and give them a call. That law firm doesn't just represent you. They often refer you to a specific network of doctors, chiropractors, and imaging centers that they have a close working relationship with. Your PIP coverage guarantees that these medical providers will get paid up to your policy limit. Knowing this, some of these clinics have an incentive to provide extensive, sometimes unnecessary treatments. A simple backache might lead to weeks of therapy, multiple MRIs, and a long list of procedures. The goal is to exhaust the PIP, meaning run up the medical bills to the maximum limit your policy will pay. Why do this? 2 reasons. First, the clinic gets paid handsomely. But second, and more importantly for your insurance premium, that stack of inflated medical bills becomes Exhibit A in the lawsuit that comes next. The lawyer can now go to the at-fault driver's insurance company and say, "Look at this. My client's injuries were so severe they required $10,000 or $15,000 in medical treatment." That massive number becomes the anchor for negotiating a much, much larger settlement for pain and suffering, which is often calculated as a multiple of the medical bills. The bigger the bills, the bigger the potential payout, and the bigger the lawyer's 1/3 cut. It's a perfectly engineered machine for turning a minor accident into a major payday. This entire system is then supercharged by one final terrifying factor: the rise of the nuclear verdict. A nuclear verdict is a jury award that is staggeringly high, often in the tens or even hundreds of millions of dollars. These verdicts used to be incredibly rare, reserved for the most catastrophic cases of corporate negligence. But in the last decade, they've become increasingly common in standard auto accident cases. Juries influenced by years of lawyer advertising painting insurance companies as evil, greedy corporations have become more and more willing to award astronomical sums to punish the insurer. The lawyers know this, and they use it as a weapon. They don't have to win a $100 million verdict in every case. They just need the threat of one. When a personal injury lawyer files a lawsuit, the insurance company has to make a cold, calculated decision. Do they fight a claim they believe is inflated or fraudulent and risk a 1 in 100 chance of a jury hitting them with a $50 million verdict that could bankrupt a smaller company? Or do they just settle the case for $200,000, even if they think it's only worth $20,000? More often than not, they choose to settle. The risk is just too great. This phenomenon has a name: social inflation. It's the idea that societal trends and changing attitudes are driving up the cost of claims far beyond normal economic inflation. And every single nuclear verdict, every single inflated settlement made under the threat of one, sends a shockwave through the entire insurance industry. That money doesn't just vanish from a CEO's bonus. The insurers have to get it from somewhere. They get it by raising rates on absolutely everyone. Every billboard you see, every commercial promising a big check, every inflated medical bill, and every massive verdict is a cost that is being priced directly into your policy. You are paying for the ads that convince people to sue, and you are paying for the settlements that result. It's a vicious cycle, and it has turned our legal system into one of the single biggest drivers of your skyrocketing car insurance bill. But it's not just the legal fees. What are those multi-million-dollar settlements actually paying for? A huge chunk of it, often the largest part, goes to medical bills. And this is where we uncover another uniquely American reason for your crippling insurance premiums: the astronomical cost of our healthcare. The United States spends more per capita on healthcare than any other developed nation on Earth. And it's not even close. We spend double, sometimes triple, what countries like Germany, Japan, or Canada spend without necessarily getting better outcomes. When you get into a car accident, you are thrown headfirst into this financial black hole. An ambulance ride that might cost $100 in Tokyo can easily cost $3,000 in Tampa. A simple ER visit for observation and a CT scan can generate a bill that looks more like the price of a used car. And your auto insurance policy is the one that has to pick up the tab. Let's be crystal clear about how this works. When a hospital treats a car accident victim, they aren't billing based on the actual cost of the service. They're billing based on something called the charge master. The charge master is essentially a fantasy price list. It's a list of wildly inflated prices for every single procedure, every pill, every bandage. A Tylenol pill might be listed at $30. A bag of saline solution at $700. These aren't real market prices. They are starting points for negotiation with health insurance companies. But when it's an auto insurance claim, the dynamic changes. The auto insurer isn't in the same negotiating position as a giant health insurance network. They are often presented with this charge master bill, this work of financial fiction, and are expected to pay it. The lawyers we just talked about will point to this massive bill in court and say, "Look at the damages. My client has a $100,000 medical bill." It doesn't matter if the actual cost to the hospital for those services was only $10,000. The bill says $100,000, and that becomes the number everyone is fighting over. So dollar for dollar, the cost of treating the exact same injury, a broken leg, a concussion, whiplash, is exponentially higher in the US than anywhere else. And since your auto insurance policy includes coverage for medical payments, bodily injury liability, and uninsured motorist bodily injury, you are essentially prepaying for access to the world's most expensive medical system every time you pay your premium. The insurers know that a simple rear-end collision could easily result in a six-figure medical claim, so they have to price your policy accordingly. They have to build a war chest, funded by you, to pay for these hyperinflated bills. But it gets even more intricate and frankly more cynical. There's a mechanism that has become increasingly common, which links the legal system and the medical system in a way that pours gasoline on the fire. It's called a letter of protection, or an LOP. Here's how it works. After an accident, a lawyer tells their client not to use their own health insurance. Instead, they send the client to a specific doctor or clinic who agrees to treat them without any upfront payment. In exchange, the lawyer gives the doctor this letter of protection, which is a legal guarantee that the doctor's bill will be paid directly out of the future lawsuit settlement. This creates a perverse incentive structure. The doctor, knowing they will be paid from a large settlement, has no incentive to keep costs down. In fact, it's the opposite. They are incentivized to provide more treatments, more procedures, and to bill at the highest possible rates, often even higher than the already inflated chargemaster prices. Why? Because the bigger the medical bill, the more the lawyer can demand from the insurance company. A $20,000 settlement claim becomes a $200,000 claim, simply because the medical bills were artificially inflated under this LOP arrangement. It's a system where the lawyer and the doctor can effectively work together, using the patient's injury as leverage, to extract the maximum possible amount of money from an insurance company. And who pays for that? You do. Every driver in your state pays for it through higher premiums. The insurance company isn't a magical money tree. Every dollar they pay out in these inflated claims is a dollar they need to collect from their customers. It's a hidden tax on driving, funneled through a system that enriches a select group of lawyers and medical providers. So we have a legal system that encourages lawsuits, and a medical system that generates bills of unimaginable size. When these two forces combine, they create a perfect storm of costs that lands directly on your insurance bill. But even if we magically fixed our legal and medical systems overnight, your rates would still be climbing. Because there's another revolution that has happened right under our noses, inside the very cars we drive. And it has fundamentally changed the economics of a car crash. Think about a minor fender bender 20 years ago. You bump into someone in a parking lot. What happens? You get a dented bumper, maybe a cracked taillight. You take it to a body shop, they pull the dent, maybe replace a plastic cover and spray some paint. The bill might be $500, maybe $1,000. An annoyance, but manageable. Now let's replay that exact same low-speed fender bender today. Your 2024 SUV taps another car. You look at the bumper. It seems like it's just a scuff, a little crack in the plastic. But you are completely, utterly wrong. because that bumper is no longer just a piece of plastic. It's a sophisticated piece of technology. Embedded within or behind that bumper cover is a collection of sensors that are the eyes and ears of your car. There are ultrasonic parking sensors. There might be a radar sensor for your adaptive cruise control. There could be a camera for your 360-degree view system. A simple crack in the plastic might mean the entire multi-thousand-dollar assembly needs to be replaced. And it doesn't stop there. After it's replaced, every single one of those sensors needs to be painstakingly recalibrated. This isn't something your local mechanic can do with a wrench. It requires specialized equipment, clean rooms, and technicians trained to work on what is essentially a rolling supercomputer. The calibration for a single radar sensor can cost hundreds of dollars on its own. The car has to be placed on a perfectly level surface, with specific targets placed at precise distances and angles, all while a computer tells the sensor what it should be seeing. If the calibration is off by a single degree, your automatic emergency braking might not work correctly, or your adaptive cruise control could malfunction on the highway. The same is true for your windshield. That little crack from a rock on the freeway? It used to be a $200 replacement. But now, your windshield has a camera mounted to it for the lane keeping assist system. Replacing the glass means removing and remounting that camera, and then, you guessed it, a full recalibration that can add another $400 or $500 to the bill. Your side view mirror? It's not just a mirror anymore. It has a blind spot monitoring light, a heating element, a camera, and an electric motor. A $170 part is now an $800 module. Even your headlights. They aren't simple halogen bulbs anymore. They are adaptive LED or laser matrix systems with dozens of tiny projectors that can shape the beam of light in real time. Controlled by a computer. They swivel as you turn the steering wheel. A minor front-end collision that cracks a headlight assembly can now result in a $3,000 replacement part per side. All this technology was designed with the noble goal of making driving safer, of preventing accidents. And in many ways it has. But it has created a brutal paradox. The very systems designed to prevent a crash have made the financial consequences of even a minor crash catastrophically expensive. The cost to repair the average vehicle has been exploding, far outpacing inflation. And your insurance company, which is on the hook for these repair bills, has no choice but to raise your rates to cover this new reality. You are paying for the safety, but you are also paying for the complexity. And the delicate, expensive nature of these rolling computers is a bigger driver of your insurance bill than almost anyone realizes. So you're driving a supercomputer on wheels, a vehicle packed with sensors, cameras, and LiDAR, all designed to keep you safe. But a minor fender bender is no longer a trip to a body shop for a new bumper and some paint. It's a trip to a specialist who has to recalibrate a dozen sensors that are embedded in that bumper. A single headlight assembly on a modern truck can cost over $2,000. A side view mirror isn't just a piece of glass anymore. It has cameras, heating elements, and blind spot indicators, turning a $100 fix into a $1,500 replacement. This is the technology paradox. The very systems that prevent accidents make the accidents that do happen catastrophically expensive. And when insurers see the average cost of a claim balloon from $3,000 to over $5,000 in just a few years, they have no choice but to pass that cost directly on to you. So when you put it all together, you start to see the terrifying anatomy of your new insurance bill. We have the foundational earthquake of post-pandemic inflation, making every part, every hour of labor, and every rental car more expensive. Layered on top of that, we have the aftershocks of a snarled supply chain, meaning cars are sitting in repair shops for weeks, not days, racking up enormous rental bills that insurers have to pay. Then the storm clouds gather. Literally. Climate change is fueling more frequent and more severe weather events. Hailstorms that used to be a nuisance are now causing billions in damages, totaling hundreds of thousands of cars at a time. Hurricanes and flash floods are submerging entire dealership lots and residential streets, creating a tidal wave of total loss claims. While that's happening, a sophisticated new wave of criminals is using high-tech methods to steal vehicles, not for joyrides, but for organized, professional chop shops and overseas shipping, leading to recovery rates plummeting and theft claims skyrocketing. And if a crash does result in an injury, it enters a legal system experiencing what the industry calls social inflation. Juries, angered by perceived corporate greed and desensitized to large numbers, are handing down so-called nuclear verdicts, tens of millions of dollars for accidents that a decade ago might have settled for a fraction of that. This forces insurers to set aside massive cash reserves just in case, and that money comes from your premiums. Finally, the very car you're driving, the one designed to be safer than any vehicle in history, has become so technologically complex that a simple parking lot mishap can cost as much to repair as a major collision used to. It is, in every sense of the word, a perfect storm. Every single dial that influences car insurance costs has been turned up to 10, all at the same time. It's a multi-front war on your wallet, and it leaves millions of Americans asking the same question. What on earth am I supposed to do? Is this just the new reality we have to accept? No, you are not powerless in this situation. While you can't control inflation or stop a hailstorm, you can take control of your own policy. You can play the game smarter than the insurance companies want you to. The single most powerful weapon in your arsenal is your ability to shop around. This isn't just a casual suggestion. It's the absolute foundation of fighting back. Insurance companies rely on your inertia. They bank on the fact that you're busy, that you don't want the hassle, and that you'll just accept your annual renewal increase. But here's the dirty little secret of the industry. Loyalty is often punished, not rewarded. Many insurers use a practice called price optimization. It's a fancy term for a simple algorithm that tries to figure out the maximum amount they can raise your rate before you'll actually bother to leave. If you've been with the same company for 5 years and never complained, their data says you're a sticky customer. You're a prime target for a larger than average rate hike because they're betting you'll just pay it. Someone who switches every 2 years, however, gets treated differently. They're offered the best introductory rates because the company knows they have to fight to earn and keep their business. You should be getting quotes from at least 5 to 7 different carriers every single year, or at the very least every time your policy is up for renewal. Don't just check the big names you see on TV. Look at smaller regional insurers too. Use online comparison tools. It might take you an hour, but that 1 hour of work could easily save you $500, $1,000, or even $1,500 a year. Second, you need to have an honest conversation with yourself about your deductible. The deductible is the amount you pay out of pocket before the insurance company pays a dime. A low deductible like $250 or $500 feels safe, but you pay dearly for that feeling in the form of a much higher premium. Raising your deductible to $1,000 or even $2,000 can slash your monthly payment. This is a calculated risk. You're making a bet on yourself as a safe driver. You need to ask yourself, do I have $1,000 in an emergency fund that I could use to cover a repair if something happened? If the answer is yes, then you could be essentially overpaying for a sense of security you don't need. You're paying hundreds of dollars extra per year to avoid a potential one-time cost that you can already afford. Run the numbers. See how much you'd save. For many people, the annual savings from a higher deductible are far greater than the risk of having to pay it. Third, dig into the discounts. And I mean really dig. Don't just assume you're getting them. You have to ask, are you bundling your auto and home insurance? That's the most common one. But what about others? Did you take a defensive driving course? Many states mandate a discount for that. Do you have a student on your policy with a B average or better? That's a good student discount. And then there's the big one, telematics. This is the program where the insurer gives you a little device to plug into your car, or has you use a smartphone app that monitors your driving habits. It tracks things like hard braking, rapid acceleration, late-night driving, and total mileage. Yes, it's a privacy trade-off. You are giving the company a direct window into how, when, and where you drive. But if you are genuinely a safe, low-mileage driver, the savings can be substantial, up to 30% off your premium in some cases. It's a way to prove you're not a risk, using your own data to counteract the scary statistics that are driving everyone else's rates up. Fourth, and this is one that catches almost everyone by surprise, your credit score. In every state except California, Hawaii, and Massachusetts, insurance companies use a credit-based insurance score to help set your rates. It's a controversial practice, but it's legal. Their reasoning is that decades of data show a strong statistical correlation between how people manage their finances and how likely they are to file a claim. You don't have to like it, but you have to be aware of it. Paying your bills on time, keeping your credit card balances low, and not applying for unnecessary credit can have a direct, positive impact on your car insurance premium. Your financial health is intertwined with your insurance risk profile. Finally, review your actual coverage. Insurance isn't a one-size-fits-all product. If you're driving a 15-year-old car that's worth maybe $3,000, does it still make sense to pay for expensive collision and comprehensive coverage? Those coverages are designed to repair or replace your car. If your car's value is low, you could easily end up paying more in premiums over a couple of years than the car is even worth. It might be time to drop those coverages, keep only the liability insurance your state requires, and bank the savings. The world of driving is changing. The relationship between us, our cars, and the companies that insure them is being fundamentally rewritten. In the near future, usage-based insurance like telematics will likely become the standard, not the exception. Your rate will be determined less by your demographics and more by your direct, verifiable actions behind the wheel. And on the horizon looms the biggest disruptor of all: autonomous vehicles. When a self-driving car crashes, who is at fault? Is it the person in the driver's seat who wasn't driving? Is it the automaker who built the car? Is it the tech company that wrote the software? The entire 100-year-old model of personal liability and insurance will be thrown into question. But for now, we live in this turbulent, expensive present. Understanding why your rates are exploding isn't just an intellectual exercise. It's the first step toward reclaiming some control. It's about recognizing the interlocking forces of technology, economics, and even climate, and then making smart, deliberate choices to navigate the storm. Your car insurance bill is no longer just a simple utility. It's a complex financial product, and learning how to manage it is one of the most essential and valuable skills a modern driver can have.